All right, guys, today what we're going to do is we're going to go over the problem 5B3, which is going to be um, your one of the worksheets that you guys have to do. I decided not to do a different exercise. I decided to go through what you're going to have to do for um, the problem A4, okay? And I just chose B3 because that's the first one that came up. So anyway, what you're going to be doing is you're going to be looking on page 183 for 5B3. And what you're going to do is you're going to make sure that you complete the entire accounting cycle, okay? That's what you're supposed to do. So you're going to be looking at the investment of everything that has been done, how it was done, um, the fact that he invested um, in cash and in snow equipment. You're going to be doing all the journalizing, okay? So you see here where he began on January the 1st, where he has cash, and notice this is what is called a compound entry. You do the cash, right? Account, $9,000. Then you do the snow equipment, which is $9,000 as well. Then you go ahead and you debit into both. Then you go ahead and you show the capital investment of of $18,000. So you see this compound entry that is being done there. Then you're going to be doing each one until the 30th, okay? Then, and of course, it shows you also on page 183, the chart of accounts. This is the PR, the a record, posting record for each account, showing that you posted it as well, okay? So you're going to be doing that. Now, it also then provides this you're used to. This is not the problem, okay? This is the things that you're used to. You're also used to, you should be in it by now, going in and going into the ledgers and posting the information for the ledgers as well. This should be 9,000, sorry. Hold on. So again, I fixed it. Where it says the $9,000 of the cash, then you're going to see your prepaid rent, your accounts receivable, all the transactions that are being done, okay? In Ledger 3, if I'm not mistaken, we see our equipment as well, the snow equipment that came in, the $9,000 there as well that was debited. So you're going to be doing the ledgers as well. Where it's going to become, where this chapter comes in is closing, is where we're going to be doing the actual closing of the entries, okay? So you're going to see in Journal 2 where we begin to do the closing entries. Now remember, as we stated in the video demonstration, what you're going to be doing is doing the adjustment data first, of course, and you'll see that on your trial balance, your worksheet, where we started out with everything balancing out, and then this is the adjustment data that you're going to be doing, okay? Then you have your adjusted trial balance. This you should be used to doing already, okay? And bringing in the information from either side because of chapter 3. Bringing that information in, doing your adjustments, your accumulated depreciation, and notice how this time you'll see that, again, you've got your snow equipment, your office equipment, how each one is being depreciated, and you're seeing that information here on your depreciation expense, and then on your accumulated depreciation as well. So you should be used to the trial balance, the adjustments that you're doing, then how to bring forward the adjusting balances after you do your adjustments, okay? If not, refer back to chapter 3. So now that we've done all of that, okay, when we're doing the journalizing, this is where you're going to do your closing entries. Once you adjust your adjustments, okay? Remember, closing entries. You're going to use 2 accounts for closing entries. The income and your expenses. And remember, the reason that they're thought of as being temporary accounts instead of permanent accounts is because those numbers fluctuate throughout the month. Items that do not fluctuate is your equipment expense. I mean, your equipment, not your expense, but your equipment, historical value. Your capital historical value stays the same. So it's only those that actually fluctuate or change because of either putting money in or the money going out that you're going to close and you're going to bring to a zero balance. so that you can start again the following month. Okay, so the first thing that we do is close the revenue of the plowing fees, and income summary is used to close the accounts. Okay, so you use that. So you then, because plowing fees is a credit, you're now going to debit it, and then you're going to credit it into income summary. And where do you see that? If I'm not mistaken, you're going to see that in your here, your income summary. Notice again the money that's coming in. All right, what we're actually doing, the plowing fees. See here, we actually are closing it. The $19,000 that are there, where it's a debit. So now we're going to credit, meaning that now this comes to zero. Okay, and again, we are doing the closing entries. Journal 2. Then we take this expenses, those that are going to fluctuate, because you're going to have different expenses at different times and different amounts. So then you're going to do the same thing. You're going to take the all the expenses, each one, and you're going to debit them into the income summary as well. Okay? So because remember, you're going to go ahead and debit, the income summary, because these are originally the normal balance for an expense is a debit. So you're going to then credit the income summary and end up with, again, checking for your net income as well, because we're taking away the expenses from the income that was made. So, for example, again, you take all of the salaries, expenses, you total them up. They should total up to $45.30. You debit your income summary, and then you credit each one of these. Now, you're doing it also in the ledger accounts. So notice, when you start with your expenses, which is in ledger 3, this is, remember, where you're doing your adjusting entries. You have to post that as well to the ledger accounts. Notice again your closing entries. Your closing entries to your income summary, your plowing fees, your ledger 4. Here we go, salaries, expense. Here we did an adjustment. Now we're doing a closing. So that when this is debited, right? So now when you credit it, you end up with a zero balance, because a debit minus a credit is either going to give you a balance or a zero balance. Advertising expense, closing entry, debit, credit, zero. Okay? Telephone expense, closing entry. It's a debit account, and we're closing it out by crediting it, and we're actually, remember, we're crediting it, and we're taking all of this into the income summary account. So when we see, again, our income summary account, all of that is being placed in. Okay? This is where we're debiting it, and then we're going to close it out as well. Okay, we're going to close out the amount. So then, once we've done all of this and made sure that all of our expenses are not only adjusted but closed as well, okay, that you're going to see then, and again, depreciation is an expense, so you're going to close that out as well. Then you're going to do your income statements. This is not difficult. This is what we've done before. Taking, again, our plowing fees or our revenue, taking all the expenses, even the depreciation, okay, because it's an expense. Here again, we see the $45.30. Then we subtract all of the expenses minus the plowing fees revenue, and you end up with your net income of $14,470. Okay. Then remember, we're taking this off from the trial balance, the adjusted trial balance. Then you take your owner's equity. Again, the investment that we made initially, and here it is. Then the net income, all right, less any withdrawals, and apparently he made $8,000 worth of withdrawals, which is an owner. I don't know that I would allow that, but who knows. So you end up with an increase in capital after the withdrawals and the expenses of $6,470. So when we add the $6,470 to the $18,000 of initial capital investment, you end up with now $24,470. This means that his capital because of the revenue that came in, minus his expenses, minus the withdrawals that he has. He now still has an increase in capital. He has money that stayed in. And remember, the equity that he has, which is why it's called owner's equity, that's the right that he has. That's how much he shows now that he's increased his company over this month. Then we do a financial statement of the liabilities, different from the trial balance that we're using just to make sure that our entries are correct. And the reason for this is because we're now taking the owner's equity of the increase and posting it to our trial balance. So here we see that instead of using just the initial $18,000, we're showing also the increase in capital of the 6,000 that we had. So we're showing an increase in his owner's capital, his owner's equity. We still take all of the assets that we have here, okay, minus the, and that's why it says less, minus the depreciation for each one. We end up with $29,000. You have your accounts payable, salaries payable, total liabilities, and of course, adding total of your owner's equity now with the increase provides you the same amount, which is $29,910. So you're still balancing out in your official financial statement of the balance sheet. Remember, assets equal liability plus owner's equity. So here's what we have. Now, the other thing that you're going to see is the post-closing trial balance. Again, the amounts at the end that you have for cash, accounts receivable, after all the adjustments and everything has been done, prepaid rent, snow supplies, office equipment, your depreciation, your snow equipment, the depreciation, your accounts payable, your salaries payable, to show your $24,000 here, adding all of this up, you end up with your $30,000 for your post-closing trial balance. Post-closing means after all of the adjustments, after everything that we've done, these are the balances that we have. And remember, these are the balances that we have starting for the next month. These are your permanent accounts. Notice, cash, how much I have left. Accounts receivable, how much I have left. Prepaid rent, how much I have left. Snow supplies, my office equipment, my accumulated depreciation, because it's accumulating how much I'm going to have for the snow equipment and the office equipment. My accounts payable, okay, didn't make any payments to that, so that's what I have. My salaries payable as well, and my capital showing my increase. So again, these are the amounts that you're bringing over, again, to ensure that everything that you've done to close up the entire accounting cycle has now been done. From journalizing, adjustment, adjusted trial balance, then you're doing your closing entries to your ledgers, making sure that everything is closed out on your temporary accounts, which is your revenue and your expenses. Then from there, doing your income statement, then your owner's equity. Then from owner's equity, doing your balance sheet, and these are your financial statements, and then doing your post-closing trial balance. Okay? Again, all of these are here, showing you again what you're supposed to have, owner's equity, income statement, what your worksheet is supposed to look like, okay? After we've worked everything out, what your journals are supposed to look like because you're posting. Again, and this is again where you're posting to the journal, daily journal, along with your ledgers, making sure that you've posted everything to the ledgers. These are all the ledger 2s that are here as well. Ledger 3, ledger 4, and ledger 5. Now remember that anytime that you need to see this and you need to make sure that something is correct, all you need to do is go ahead and pause the video so you can see what's going on, okay? As with anything, don't hesitate to contact me, um, text me, whatever you need. Again, I'm available on Sundays between the hours of 8 and 9 to do the Google Hangouts so I can see your screen. But you can also text me a picture of your screen, and I'll get back to you as soon as I can over the weekend and let you know whether or not, or throughout the week, and let you know whether or not your balances are okay. All right? I'll see you guys on the flip side.